This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 3 is a relatively short chapter on budgeting, and we begin by setting out the purposes or functions of budgets. And most books cover these sorts of headings one way or the other. And the first is forecasting. If you're going to produce a budget, it does rather imply that you've sat back and tried to forecast, tried to make some sort of realistic predictions about what's going to happen in the future, and that of itself is extremely useful. Based on forecasts, you can then plan. Do you want to extend your production capacity? Do you want to plan to open in another country? What exactly do we want to do in the forthcoming period? Communication. The budgets are written down and they are distributed to various departments and departmental heads, and it communicates to these people what the plan is and what they are supposed to be achieving in the period. Coordination. Very often budgets are produced by people sitting around in what's called a budget committee. There's communication, of course, there, but also if the sales people think that 100,000 units can be sold, and the production people say, well, we can only make 80,000, then you have to coordinate in some way for the shortfall of 20,000. Perhaps make in a slack period and put in inventory, perhaps arrange for subcontracting. Control. The budget expenditure which you are given, you're not supposed to over it. It's a way of controlling expenditure and controlling the direction and achievements of the organisation, because most people realise that if they don't achieve what they're supposed to according to the budget, there's going to be some sort of investigation into that, and it may reflect badly on them. Of course, the main control mechanism is probably variance analysis and operating statements. Adverse variances tend to be frowned upon. Favourable variances tend to be looked on favourably. But of course we know there's more to it than that. An adverse variance is caused by the difference between two figures. It doesn't mean performance has been bad. It could be that the original budget was incorrect. So the investigation, effectively the evaluation of how people have done, needs to be done sensitively. Authorization, it's kind of connected with control. But if you give, let's say, the advertising department a budget figure of, let's say, $3 million, you're really saying you are authorized to spend $3 million. I, as a member of the board, I'm not going to keep looking at you and deciding whether or not you're spending that $3 million wisely. I'm not an advertising expert. So I authorize you to spend $3 million, but you have to spend it really in the best way you know how. But don't keep coming back to me with little extra bits of authorization being required for small extra bits of expenditure. Motivation. We touched on this a little bit earlier. The problem is here, if you set a budget which is very low, you're likely to pull down people's actual performance, but below what it would have been. If, however, you habitually, all the time, set budgets which are very high, and people can obviously never attain these, no matter how hard they work, then it's likely to be very demotivating. And finally, there is evaluation. You have to be cautious how you evaluate. It's very difficult to say there's an adverse variance, that person was responsible for it. In most organizations now there are interdependencies. So if repairs and maintenance was going above budget, that could be the fault of the repairs and maintenance manager who's been sloppy, but it could be caused by sales. We're running the machines for longer to meet increased sales. It could be the fault of the production manager who isn't very good at carrying out routine maintenance, so that when something goes wrong, a really big cost has to be incurred. It's worth trying to remember these. It's a little list. I have remembered this in more or less the same way for many, many years. I look at the initials here, and I say to myself, if we go down these initials, few people can comfortably carry a male elephant. Like most mnemonics, it's pretty stupid. But it's going to, if you have to talk about the functions of budgets, it's an easy way of remembering 7-8 things, whatever's in the list. What else on budgeting? Well, the different types of budgeting. You can have a fixed budget, which is produced at one level of output only, and actual is always compared to that. Or you can have flexible budgets, which are typically prepared at a number of different potential levels of output, and it enables you then, later on, when you see the actual level of output, to better compare to budgets. Incremental budgets, that's the way most budgets are done. That really means taking last year's budget, adding a bit for inflation, plus often a bit more for safety. And that's the problem, really. They're easy to do, but they don't really force people to say, do I need to spend this money? Is there a better way of spending this money? And human nature being what it is, we tend to like a bit extra in our budget. If there's a bit of extra in our budget, we can easily keep the costs under that. We'll bring the costs up towards it because, of course, we need to justify a big budget for next year as well. Zero-based budgeting means really starting with a blank sheet, no expenditure on it at all. And in the ideal situation, it means justifying every dollar that's been spent. And you're always thinking, do I need to carry out this function? Or do I need to carry out the function to the same extent? Because very often there's a pattern or a choice of spending more and getting better service and so on. Could we do better by subcontracting that function as well? It's slow to do, of course, if you're building it from zero. And what some organisations do is they don't do a full 100% zero-based budget in every department every year. But they say for 2 departments, right, you're zero-based budgeting this year, another 2 departments next year, and so on, so that there is this kind of program of getting people to think about expenditure and see whether or not it's necessary, because if you don't really grapple with this expenditure, it's going to become too high and performance is going to suffer. A rolling budget is a budget which basically is always looking, say, 12 months ahead. So as we pass through January, then you pick up next year's January's, and you go through February, you drop that one and pick up next year's February as well. It keeps roughly the same amount of time in front of you. And activity-based budgeting, this is basically on using activity-based costing for budgeting. Almost certainly it's going to be more accurate. Almost certainly it's going to be slightly more difficult. But if we want to improve performance, I think accuracy in budgeting is what you want. We will later on, not in this chapter but in another chapter, we will go through a simple example on activity-based costing. But basically it means the results you get from your activity-based costing, you're going to be using those as the basis of calculating your budget. Budgeting and behaviour, which we touched on that, to slack a budget, to hard a budget, and so on. But Hopwood came up with 3 management styles in which managers use budgets. And first of all, you have what's called the budget constrained style. In the budget constrained style, the manager, in a way, goes down the operating statement, and anything that says adverse variance, that is by definition wrong, bad. The manager is not interested in any explanations. The manager simply takes a view, I don't want to see any adverse variances at all, I don't want to hear any excuses. Now this is not great. This tends to lead to very bad relationships between subordinate and manager. It tends to also encourage subordinates to misreport, to move expenditure from where they're going over expenditure into another category where they're still under expenditure, and so on. Because what the subordinate will sometimes feel is that they've gone over the budget for the right reason, or they've gone over the budget and they've really no choice but to do that. Profit-conscious style of manager is saying variances, certainly adverse variances, are important. We'll be going down the operating statement, seeing where expenditure is too high, and ask the subordinate, why have you gone over there? And the subordinate might say, well, this machine kept breaking down, and we had a very important order from a really important customer, and the machine kept breaking down and this order was going to be late. So what we did was we spent a lot of money replacing a part in this machine that seemed to be causing the problem. And we know that went over their maintenance budget, but we got the product out for this customer on time. The customer is delighted, and I'm sure we're going to get more orders in the future. So what's important here is that the long-term profitability is considered, and the idea would be the supervisor or manager would assess that decision that was made and say, right, you've gone over budget, but you went over budgets for the right reasons. And finally, there is the refreshing non-accounting style. The non-accounting style is one which essentially says the manager doesn't care about accounting, doesn't care about finance very much. Hard perhaps to imagine a situation where that's going to arise. It's probably less common now, but it did to some extent arise in years ago, perhaps in our National Health Service. Then the procedures, the drugs and so on that were available to deal with people, to treat people, were relatively simple, relatively cheap. And to some extent, anyone who needed a procedure, there was money to have it done. Now, with the increasing sophistication of medical procedures and the expensive drugs and so on, the government is, and indeed hospitals and hospital management, is looking much more closely at the financial aspects. But it used to be, people would say, finance is not important. It's just an irrelevance in what we're trying to do. There'll always be plenty of money, and that was the non-accounting style of budgeting. You may be required to produce a budget. This shouldn't be very difficult. You obviously have to read the question and read about how the costs vary and behave and so on. And what we've got here, and it's in the notes, is just a reminder of what you might call very typical kind of manufacturing budgets. And you just have to be careful, particularly I think about inventory and thinking, have I got to where I need to be for a particular figure? So what we've got here, generally you're starting with a sales budget. The sales may be the key budget factor, and it's really driving everything else. And the number of units you are going to be producing is not necessarily the same as the number of units you're going to be selling. So to go from sales units to production units, you have to take into account the opening and closing inventory of finished goods. So the production number of units, well, you have to produce what you sell. You also have to produce enough for what you want to be in closing stock, but you get a head start, if you like, from what's in opening stock. So your production in units is sales plus what you want in closing stock, less what you already have in your opening stock. So this here, let's say, is going to be in units. And it's pretty simple then to go down to labour. Each unit will take so many hours of labour, each hour of labour will cost so many dollars and so on. It's generally pretty simple to go to factory overheads. They tend to be absorbed on a per hour basis as well. But you just need to be a little bit cautious about your raw materials because the production doesn't necessarily mean that you're going to buy those raw materials. So if we want here raw materials purchased, then what we need to purchase enough raw materials to account for the raw materials needed in production, plus we need in there the raw materials in the closing inventory, the closing stock of raw materials. But we again have a head start. We already have some opening stock of raw materials. So what we're going to purchase in any particular period is the raw materials used in production plus what you want to be in closing stock less what's already in opening stock. This allows us to work out the cost of goods sold, allows us to get to a gross profit. And then we are going to have selling and distribution expenses and general admin expenses. Sometimes the selling and distribution expenses will be variable. They will relate to the number of units sold. Sometimes they won't be. It's just an amount of advertising, and then you hope that you're going to get the sales and so on. Often the general and admin expenses are often fixed. So it could be rent every month, insurance every month, administrative salaries every month, maybe depreciation every month, and so on. We get the budgeted income statement, the budget and profit and loss account, if you like. And then what we have in here, we want to get is the cash budget. And the big thing in here, of course, is your timing differences. Because what you manage to sell in a particular month is not the same as the cash you're going to get in that particular month. The customers could take 1 or 2 months credit and so on. Similarly, whatever we're going to be buying in a month is not necessarily what we're going to be paying to our suppliers in a month. Again, we'll be taking some credit as well. So the cash budget is very much dependent on timing differences, and anything we can do, of course, to improve those timing differences, to get the cash coming in earlier, maybe to reduce the amount of inventory that we have to buy and so on, is going to be improving our performance. Don't forget stuff like capital expenditure, and also we put in there tax, dividends, and the like, cash outflows by and large, which have nothing to do with sales and purchases, they're regular monthly flows. And once you've got your sales, once you've got your cash, once you've got your inventory, once you've got your receivables, once you've got your payables, you are pretty well in a state to be able to draft the budgeted statement of financial position. So that's budgeting in a profit-seeking organization. In a not-for-profit organization, there are certain differences which we just look at very, very briefly here. Something like a school, something like a hospital, maybe a government department, a local council. They often have very little control over revenue. The revenue may simply be given to them by the government. It may be really established by tax rates or local tax rates and so on. If it's a charity, they can try to collect more money, but of course they can't just assume they're going to get more money and so on. It's not quite as easy as perhaps launching a new product. Often there is no revenue at all, because it is part of the mission of the organization to give away goods or services free. A charitable organization or a state organization which provides education and healthcare free of charge. And this raises some problems. If you don't have any revenue, you don't have any profit. How do we know whether money has been spent wisely? How do we know whether we're getting value for money? Increasing revenue is a pretty good sign, not infallible, but a pretty good sign of a success in a company that's producing the right products and so on. But in the absence of that, how do you know that a school is educating people to the right level? In profit-seeking businesses, if they have a cash crisis, they can often arrange an overdraft or perhaps take out a loan. Very often, non-profit-seeking organizations are prevented from doing that. They're not allowed to operate at a deficit. There tends to be more rules and regulations about how you can reallocate money that's in the budget. Very commonly in government budgets, it's set out at the beginning of the year, or even long before that, how much you can spend on road repairs, how much you can spend on waste collection, how much you can spend on water and sewage services and so on there. And no matter what happens, you can't really swap from one to the other. And it ends up that people will spend on road repairs, even if road repairs aren't really needed. And in fact, what they really need is better waste collection, because that's fallen into some problems. And finally, budgeting tends to just to be for 1 year. Very often the budgets are set for 1 year, the tax budgets are set for 1 year, the amounts are allocated for 1 year. Government is often rather short-sighted, working from political expedience to political expedience, and therefore this concentration on the short term can be counterproductive. It's also often incremental. Relatively little zero-based budgeting is exercised. Do we need to spend this money at all? And if the government does embark on that, it's normally regarded as a fairly radical step. Of course, this budgeting process, which we've seen, is actually quite complicated. Working through from sales to production to purchases to cash flows, etc., etc., takes a long time. There's a lot of negotiation within organizations. There's a lot of trying to arrange budgets which you feel are safe for yourself, which are perhaps not too demanding. Every month there's likely to be an operating statement, and you have to explain the adverse variances. You have to always put up a defense against that. And some people are beginning to think that perhaps budgets are not as useful as perhaps were originally thought. There are statistics around which show that managers perhaps spend 60 to 80% of their time just dealing with budgets. And that's a lot of time when maybe they should be dealing with the needs of clients and looking after employees and so on. And this has given rise to a movement called Beyond Budgeting, which really says that this has had its day. There are many disadvantages, and there may be better ways in which we can get good performance from organizations.